IBM pays a sweet dividend at 4.3%. However, like a lot of big tech corporations today, they're starting to grow profits and revenue overall. So let's look at this company today. In these videos, we look for undervalued companies that are set for high growth. This maximizes reward while minimizing risk. We'll be looking at who IBM is, how do they generate revenue and net income, then what's their trend in being able to pay out dividends. So let's get into the video. This company is IBM, their stock ticker is IBM. They're priced at $147 per share right now. They have a market cap of $135 billion, a P ratio of 23, so that's a little high. They're established in 1911, and I think they've been paying out dividends for about 101 years right now. So this company's been around for a while. They're very well established. They have a yield of 4.3%, which is really why I'm intrigued to look into this company as a potential play in the tech area. Then they're not a dividend aristocrat yet, but they probably will be in 4 years. Now, just as a quick disclaimer, I'm not a financial advisor, and this is not financial advice. Do your own research before ever considering investing in the stock. And another quick disclaimer, this information is incredibly valuable, so make sure to subscribe, like, and comment on this video in order to just make my day. So please do that right now. Let's go over the checklist and determine should we be even looking into this company. So they have a starting yield which is very nice and in our acceptable range. Market cap is very high as well. They have a little bit high of a P ratio, and we'll look at trends in profits and revenue to determine if that's acceptable. Their 5-year average dividend growth rate has been killer at over 11%. 5-year average payout ratio has been good. It's been on an increasing trend, but still, it's not terrible. It's not at 80% or 90%, it's just at 60%. Consecutive years of dividend increases is more than 10. We understand their business, and they can't really be disrupted by Amazon. Important dates to understand. Great, so hopefully you know what all these dates mean. If not, you can see a description right there just in case. But today is September 2nd. The next ex-dividend date you need to be aware of if you're investing in IBM is November 9th, and that's in 68 days. Date of declaration October 31st, date of record November 10th, and then the payment date when you get your dividend is December 9th. So you have plenty of time to determine if this is an investment for you. Okay, so let's go into how do they generate revenue and net income. So they've been around for a long time, and they've changed their business model over time and adjusted to what's really profitable and what's doing well. So with regards to their business model, currently they take ownership of client IT platforms, maintain data infrastructure, and then cloud storage as well. Really, a lot of their business comes from huge contracts with big companies. It's important to note. For revenue, last year they did $80 billion, but however, year over year it's been decreasing about 5%. Very concerning for me. With regards to growth, they are struggling, but cloud storage has been really a big driver for a lot of big tech companies right now. With regards to competitive advantage, huge company. They've been around for a long time, so they have a lot of experience and long-term contracts with other companies. In regards to risks, competition is getting very intense, and there's concerns about slowing performance. And what's a really cool picture is right here, and that breaks down their 5 main revenue segments. So feel free to pause the video and check that out if you haven't already. Now let's check out their balance sheet and financial situation. Basically, we understand how they generate revenue and profits. Let's look at how this company stands right now financially. We don't want to see too much debt, of course, and then we want to look for plenty of assets when compared to liabilities. So with regards to current assets to current liabilities, that's a pretty good ratio. We want to see around 150%. As long as above 100%, we can keep looking into the company. And total assets to total liabilities have a very similar ratio. Interestingly, I just thought it was kind of funny, but current liabilities has been decreasing year over year, which is actually quite a surprise to me. But overall, nothing really special on the balance sheet, and let's go into their current valuation. So in the past 5 years, the stock has done terrible, like plainly terrible. In this fantastic bull market, these guys have done nothing, and they've been worse than nothing. They've returned negative 20%, which is about negative 4.4% year over year. In the past year, the stock is up about 2% compared to the market, which is at 14%. P ratio is a little bit high at 23. Price to book ratio is high. Then price to sales ratio is nice and low, and debt to equity ratio that is a little high. Nothing to be too fearful about or to just hit the quit button on this company yet. But this is a very important page that I want you to pay attention to right now. So let's look at their trends in how this company has been doing. So with regards to revenue, we want to look at the 5-year column. We want to understand what's been going on in recent years and then compare that to the 10-year averages. So with regards to the change in revenue year over year, revenue has not been doing hot at all, decreasing 5% year over year. net income has been decreasing 22% year over year, and then dividends paid out has been increasing at 6.75%, which is very nice to see. With regards to the payout ratio, it's okay, but really look at where the payout ratio has gone since the 10-year average. It was only 40% for those 10 years, which is fantastic. As a dividend investor, you'd love to see. However, now it's way higher. It's already at 60%, which isn't too great for a dividend investor and actually pretty conservative. But one reason that's happened, obviously, is because of this huge dividend growth rate. They've been raising their dividend like crazy. To get into this company 5-10 years ago would have been fantastic, and you would have had immense returns on your dividend alone. 5 to 10 ratio is only okay, and basically that's just comparing what is the change in dividends being paid out. Is it slowing down? And this says it is slightly slowing down, but they're still maintaining a very aggressive raise in their dividend. And actually, overall, they have a very nice current yield. So basically, the story so far, this company pays a lot out in dividends. They love giving that money to their shareholders. They have a little bit amount of room to keep paying that out, but they're really going to have to look into their performance and changing revenue and net income to fix this overall situation. So let's use my quick calculator to determine how much longer they can be paying out dividends and dividends, really. So based on their current performance with regards to net income and raising dividends, they'd only have 2 more years of raising their dividend. Now, what's likely going to happen here, this really just suggests that either the company's going to stop paying dividends, which really is very unlikely to happen, or this company's going to slow down their dividend growth rate. It's likely going to be the latter. And that's basically because, they've been raising their dividend like crazy, and there's no way they can continue to raise that dividend that quickly unless some serious changes are about to happen in this company, and that's what we're investigating in today's video. So let's look at the 10-year trends, because I love charts and I love visuals, and that's just so much easier than reading a bunch of numbers. So with regards to the price-to-P ratio, remember, we like to see this company trading below. We like to see all these little stock prices, which is the thin blue line. We like to see it below these colorful lines, because this basically suggests, the colorful lines suggest where the stock should be trading at. So if the stock price is above where it should be trading at, it's overvalued. If it's under, it's undervalued, and we like undervalued companies. But in this picture, in the first picture for the 10-year average, this company does seem to be very overvalued. Their average P has been around a 13.6, and their current P is a 23. That's disgusting. That's almost unacceptable to an extent. But we can't give up on this company yet. We have to look forward as well. This is just the past. Price to EBITDA, they're basically priced how they're supposed to be. Okay, great. So let's look at their price to sales. They're a little bit undervalued with regards to price to sales. They currently have a price to sales ratio of 1.7, and their average price to sales has been 1.8. With regards to price to book ratio, they're actually a little bit undervalued, but overall they have a high price to book ratio compared to the industry, which is okay. It's not the most important trend, but okay, let's look at this. So revenue has been basically steadily decreasing for 10 years, and dividends have been very nicely increasing during that time. So that's concerning. And then in addition, you can see that net income has just had a huge drop off and just tanked, and it's pretty concerning right now where it's at. Operating cash flow has been decreasing, and these payout ratios have been skyrocketing. We do not like to see this, and this is absolutely making us feel more concerned for potentially investing in IBM. For the price to yield, basically you've only been able to get this company at 2.63% dividend yield. However, they're currently yielding 4.3%. So if this was a potential, if we determine IBM to be a great investment, or just have a great financial situation and have a great potential to generate more revenue, net income, then we'd be incredibly interested in this company, because you're getting at such a high yield based on where it's been traditionally. And then you can see just net income has been struggling, and then the dividends per share being paid out has been increasing like crazy. So look at the price to earnings ratio. Currently, they're still a little bit overvalued. It's not as bad as earlier, but still, look at that. The average P has been a 13.8, and right now it's at a 23. They had a pretty brutal recent year, and then there's some interesting signs on whether or not they'll be able to turn that around, and that's what we're looking into. And then, as again last time, basically a price to EBITDA, they're being priced at that almost exactly. So with regards to price to sales, they're basically fairly valued. Price to book ratio, they're a little bit undervalued, but we don't really care about the price to book ratio too much. Revenue, instead of just having a huge decline, it's been actually a little bit more flat, and then net income decreasing, operating cash flow basically plateauing. Payout ratios have been increasing. With regards to dividends, as you can see, it's the same story. Raising their dividend very nicely. It's a great time to enter a stock if you're just going for that current yield, but that's absolutely not what we're going for as a dividend growth investor. So basically, the story has been, I'm very concerned for this company. I don't think it's a great investment right now. However, that's based on the past. That's like one-sided story. We can't just judge all of our assumptions, make all of our assumptions based on the past. We have to look forward as well, and we do that by looking at recent news and then some of analyst predictions. So going to the recent news, I love to go to the Motley Fool and just see what they're saying. So it's interesting. It's very easy to be bullish on a stock, and Motley Fool in this case seems to be extremely bullish. As I said before, big contracts are pretty important for IBM, especially going forward. And so to basically read this article, it says the deals keep coming for IBM. The tech giant is continuing its streak of signing major deals at home and abroad. So they reported their third quarter of growth earlier this month, partly of better performance in its services segments. Services tend to be very profitable, and that's why it's key for them to continue growing that. Services account for about 60% of IBM's total revenue, so a little bit of growth goes a really long way with this company. So basically signed huge recent deals. So that's good, great for them. Expanding its Anthem, we can see what this is talking about. IBM is expanding its existing services agreement with Anthem, so lots of big deals. And services are picking up. IBM signed 13 services deal worth more than $100 million in the second quarter, and its total signings grew 6%. And then this is another cool article about some innovative things they're doing, but really seems Motley Fool likes to see how they're doing. They're starting to sign a lot of big clients, and that could be, if this was a turning point, this would be an absolutely amazing time to get in. But really, I'm still not too confident about this company as of right now. So let's look into what some of the analysts are thinking. So analysts are giving okay reports. Some see going up as much as a 36% in the next year. The median is about 12.7%, which is right around what the market will return if it maintains its steady pace so far. And then some people see it crashing a little bit down towards 15% and hitting that 125 price mark. Overall, analysts, there's out of about 24 analysts, 6 say buy, 15 say hold, and 2 say sell. And some basically positive forecasts for earnings per share, sales, and everything in between, but really nothing special and nothing that makes me super excited about this company overall. So let's get into the conclusion that I have about this company, just going through our checklist. And remember, guys, in order to be a great investor, develop a system, consistently modify it, and stick to it. Feel free to innovate it, but you should continuously be building some sort of system, some way to stay consistent with your trades so that if your trade goes wrong, you know exactly why. You can just go back and modify your system. Otherwise, you're just playing a guessing game and really just going for average results, and that's never what we're going for. Absolutely never. We want fantastic results, and we get that through being disciplined, building a system, and continuously trying to become a better investor. So let's look at the year-over-year net income growth. Basically, it's been horrible, minus 22% year-over-year. With regards to year-over-year revenue growth, not good either. EBITDA, terrible. Basically, their current PE ratio is okay. Current yield is very nice, well above 4%. Dividend growth rate has been just fantastic, and that's what's been interesting about this company. Will they turn basically into an AT&T where they load up their payout ratio, pay a ton of dividend people who invest in their company, but then it's only at 6%, so it's really not that much of a dividend growth investment, which is what we want. And the dividend payout ratio is a little bit high right now, and I think it's only going to go up much, much more, and then just a brutal time span until net income equals dividends, but that's just basically suggesting their dividends going to be slowing down a lot in the near future. So overall, would I buy or not? And for me personally, I would say no. And I would say there's a couple reasons why. First of all, their growth in revenue, net income, and EBITDA has been terrible. It's been really, really brutal. This company looked fantastic 15 years ago. Such a low payout ratio, consistently raising that dividend. But because net income and revenue has slowed down so tremendously, this is actually scaring me as an investor. If I was invested in this company, and entering this company doesn't even cross my mind right now. In addition, it's also important to note, I think revenue says a lot. This space is getting more competitive, and to be a services company and have very profitable services but still be struggling with growing revenue and profitability overall, that is very concerning to me. Now, one of the risks with not investing in this company right now is that maybe they're at their turnaround point right now. Their current yield is at one of the best prices ever, 4.3%. You've only been able to really get this company at 2.3% or something like that. So entering this company right now, you're getting basically a 50% increase than ever before in that current yield. However, but that's based on the assumption that they're going to continue to raise that dividend year over year, and it's going to be a great story overall. However, that's really not the case and not what we're seeing right now. So basically, to reiterate, the one risk with not investing in this company is that this company could be making a turning point, and it could have been an incredible time to invest in this company. However, I do not see that turnaround happening, and because of just terrible declines in revenue, net income, and EBITDA overall, I do not see this as a good investment by any means. Now, let's say, always, I love using my calculator. So let's say this annual stock price is 0. We just entered. This is into information on what IBM has been recently doing, and so if they're able to maintain, let's just say a starting dividend yield of 3%, and then their dividend growth rate was able to be raised 11% year over year, like it has been. So this is the results if IBM maintained, if they're able to sustain and turn around revenue and profitability, this would be our results for investing $15,000 a year. We'd be generating $250,000 salary from dividend passive income after 30 years. We'd be doing nothing. We'd be sitting at home watching Netflix, and we'd be making $250,000 per year. But that's if this company turns it around. Now, do I think this company will turn around? Unfortunately, no. But it'll be interesting to see if they can really innovate in this space, if they can continue to make a lot of deals and just turn around this trend in revenue and profits overall. And if you see signs of that, definitely keep this stock on your radar, because it might be a home run if they turn around, but the chances of turning around, I need to see a lot more to make that overall conclusion. So I hope you found this video very helpful. Remember, this was not stock advice, so do your own research. And then in addition, you have to remember, this was incredibly helpful, valuable information that I hope you all appreciated. Make sure to like, comment, subscribe if you haven't already, and then comment what companies you want me to talk about in the future, because I love making these videos. I'm going to keep trying to make these videos as frequently as possible. And yes, just thank you so much for watching. Thank you so much for being patient with letting these videos come out. And if you haven't already, check out my Excel sheet in the description below. You can get this exact Excel sheet and also get tons of more insights into investments I'm looking at and just what's going on in my mind. So make sure you check out this description. Make sure you like, comment, subscribe, and I'll see you all in the next video.